This chart compares the SpaceX IPO valuation to recognizable brands on Earth. At $1.75 trillion, it is valued higher than Coca-Cola, McDonald's, Disney, Nike, and Starbucks combined. The company carrying that valuation lost nearly $5 billion last year. If you are wondering who is buying shares of a heavily unprofitable company at this price, the answer is that in a few weeks, you likely will be, whether you decide to or not. This listing exposes a mechanical pipeline that feeds a loss-making enterprise directly into the index funds sitting inside millions of ordinary 401k retirement accounts. While SpaceX is famous for rockets and plans for Mars, the public entity is actually three distinct businesses stacked on top of each other. The first business launches rockets for NASA and the Department of Defense. It accounts for a fraction of the company's $18.5 billion in total revenue. The second business is Starlink. With over 10 million active subscribers and thousands of satellites in orbit, it drove $11.4 billion in revenue and over $4 billion in operating income in 2025. This chart breaks down the overall revenue split compared to its operating losses. Right next to the profits of Starlink sits a third business, an AI segment called xAI, absorbed before the IPO. By the time that merger closed, every one of xAI's 11 original co-founders had left, and the division was driving a $6.4 billion operating loss. xAI was folded into SpaceX at a valuation of $250 billion, yet it generates an estimated $500 million in annualized revenue, an exceptionally low output compared to its AI competitors. When you combine those three segments, the final 2025 balance sheet shows $18.5 billion in revenue, overwhelmed by nearly $5 billion in net losses, driven by the AI division. Every dollar invested in this stock funds the satellite network and the rocket launches, but it also subsidizes a volatile, cash-burning AI startup wrapped inside the aerospace business. The Nasdaq 100 index is tracked by more than 200 investment products, holding over $600 billion in combined assets. When a company officially joins that index, every single one of those tracking funds is mechanically required to buy its shares. Historically, newly public companies underwent a process called seasoning. They waited roughly a year before index inclusion to prove their stock was stable and their operations were transparent. This timeline visualization compares that traditional 12-month waiting period against a new set of rules. Just months before the SpaceX listing, Nasdaq adopted a fast entry policy that admits megacap companies in as few as 15 trading days. FTSE Russell adopted a nearly identical mechanism, allowing eligibility after just 5 days. FTSE Russell also added a carve-out bypassing standard minimum public float requirements. This allows SpaceX to qualify despite having a public float of just 4%. Analysts estimate these new methodologies will force $22 to $27 billion in automatic buying from passive funds. These purchases happen not because a fund manager analyzed the asset's fundamentals, but strictly because the rulebook commands it. When SpaceX priced its IPO at $135 a share, the order book was heavily oversubscribed. Demand reportedly approached $150 billion against a $75 billion target, with retail investors receiving a 30% allocation. Within days of the public listing, the stock price surged past initial Wall Street price targets, settling in a range between $190 and $206 a share. 1 week after the IPO, the company announced its first acquisition as a public entity. It initiated a roughly $60 billion all-stock deal to acquire the AI coding company Cursor, a division that burned billions of dollars in 2025, bypassed historical waiting periods, absorbed public index money, and then multiplied its financial obligations just days after listing. There is a legitimate counterargument to this skepticism. Starlink's margins have climbed to roughly 63%. The exact mechanism that automatically buys the whole market for you, safely and without judgment, also blindly buys unseasoned, newly listed assets simply because they clear a freshly lowered size threshold. SpaceX's combined long-term success is something nobody can perfectly predict today, but a mechanical reality of the market has shifted. Index fund automation has evolved from a tool that safely matches the market into a guaranteed, unthinking buyer for whoever changes the rules next.